Welcome to Top of Mind, the show where we talk to real estate industry insiders and experts about the biggest trends impacting the market today. Enjoy the show.
Mike Simonsen here. Thanks for joining me today. Welcome to the Top of Mind podcast. This is where I talk to the smartest leaders, thinkers, and doers in the real estate industry. For a few years now, we've been sharing the latest market data every week in the Altos Research weekly video series. With the Top of Mind podcast, we're looking to add context to the discussion about what's happening in the market from the leaders, the people who are creating other views than what we have inside Altos. Each week, of course, Altos Research tracks every home for sale in the country, all the pricing, all the supply and demand, all the changes in that data, and we make that available to you before you see it in the traditional channels. And people desperately need to know what's happening in the housing market right now. The market was frozen so solid last fall, and now suddenly the landscape is changing again. Everyone is worried about what might happen in 2023. So, if you need to communicate about what's happening in this market to your clients, your buyers and sellers, go to altosresearch.com, book a free consult with our team, and we'll dive into your local market and we'll talk about how to use market data in your business. But speaking of data and informing the participants, the buyers and sellers in the housing market, I have a terrific guest today, Dr. Orphe Divounguy. Orphe is a senior economist with Zillow, with Zillow's economic research team. And you may have read his columns in the Wall Street Journal, CNN Business, The Hill, National Review, USA Today, Chicago Tribune, and Crain's Business, or seen him on TV. He's frequent guest on CBS, ABC, Fox, and other national news channels. Orphe is really one of the top experts on what's happening in the housing economy right now. His perspective from Zillow is really going to be fascinating to see what we can learn today. And so I am super excited to talk with him today. So Orphe, welcome.
Thanks for having me, Mike.
So it's really great. And, you and I interact on Twitter and LinkedIn, and I've started to really get a sense of your perspective on the market. But before we dive into right into the data, give me a little bit of background on you, how you got here, how you developed your expertise.
Yeah, that's right. With a name like Orphe Divounguy, that's the first question I always get. Where are you from? I was actually born in a small country in Africa. And I was really curious about economic development, right? So, why is it that some countries are blessed with a vast amount of human and physical capital and grow really fast, and others don't, right? And so I spent a little bit of time at the Financing for Development Office at the United Nations, and then decided to embark on a journey to do a PhD in economics. And that journey led me to the University of Southampton, just about 90 minutes south of London. And there, I met some really interesting people, researchers, and my interest really shifted to focusing more on, the causes and consequences of trading delays in markets, right? So the housing market is a perfect example of this, right? So, if you consider credit and housing markets, the fact that they're linked, most people must get a mortgage before they can buy a home. That process takes some time. Then you get on the housing market, and then you have to look for the right home for buyers, for sellers. It means, getting the right offer, and you have multiple multiple offers to consider. And so that process takes time. And so, how difficult it is to secure a home loan will have an impact on the number of home shoppers in the housing market. And how long it's going to take to sell your home. Another good example of the impact of trading delays is, if you think a little bit about the people who have to finance these mortgages, there's a cost of holding funds liquid. And so if it takes longer for buyers to find a home, like we saw during the pandemic, there were bidding wars. It was really difficult for a buyer to get in a home. Then the net present value of lending to potential home buyers goes down. And so as a result, these lenders must be compensated with higher mortgage rates. Of course, right? So, when the activity is so robust, everybody wants a loan. You expect mortgage rates also to increase. So that's kind of my background and how I got into this. So I studied housing markets. I studied labor markets. And also credit markets, and kind of the interaction between these markets, and how trading delays or frictions in these markets might actually affect bargaining power and price formation in those markets.
That's a really interesting perspective. The trading delay equals inefficiency, and therefore cost and.
Yeah, you can get, it's probably because you have maybe congested markets, right? So, if imagine multiple queues, right? So people, you saw during the pandemic bidding wars, you had open houses with, 40, 50 people waiting outside, right? So you have these congested markets. And so, as a buyer, the likelihood that you get the home goes down when there's a lot of offers, right? You can first. And so that will also inform, like, you go in the market, you're like, okay, maybe I'm not going to be able to get this house over here because, there's so many offers. I love Zillow's website because, even for renters, you can see how many applications have been submitted for a rental, for example, right? And so that will inform your strategy. Okay, should I apply for multiple homes at the same time? Where do I have a better chance, right? And so, these congestions in the market will definitely impact your strategy.
So that's really fascinating. And do the trading delays, does that interest in the trading delays, does that tie back to some of the developing economy work that you were doing early? Like, is there a relationship there?
That's a good question. I moved away from it altogether. I moved away from it altogether and just got really fascinated with the dynamics of these markets and these frictions in the markets. I did an interesting paper back in grad school that looked at how these frictions might actually influence migration decisions. People will move from one place to another depending on housing market and labor market prospects, right? And so, and of course, these frictions in the market, will determine, where to search and where to go. Where do I have a better chance of landing that job I'm after, right? And so, you could think of potentially, going back, using that knowledge to go back and study, why people migrate legally, or what could end up, when you look at international migration, why do people migrate legally? Why do some workers end up working illegally in some countries? What are the long-term effects? We could apply it in various ways, and it's just absolutely fascinating.
Yeah, the labor lag time in real estate is a fascinating one. One of the arguments, or one of the complaints that the Twitter sphere has about the real estate market is, there are 1.5 million realtors, and there's only a few, whatever, there's 500,000 homes on the market, so right. There's a lag between the hot real estate markets and the number of realtors participating in it. Let me run Mike's hypothesis by you and see if you buy this. So I have a hypothesis on the realtor industry, which is we always have the perfect number of realtors, with maybe a little lag, because it's actually really efficient to get in and out of the real estate industry, right. Where the conventional wisdom in the industry is that there's too many. And I feel like, we always have the right amount, maybe with a little bit of lag. What do you think about Mike's hypothesis?
Well, yeah, I mean, I don't think anybody goes into the market if they don't think they're going to be able to sell homes, right? If there's no expected profit from going in and becoming a realtor, we shouldn't see a lot of realtors going in. I into the industry because they see potential. So yeah, I tend to agree with you in the sense that I don't think there are too many realtors. I think that realtors are well informed and they are going into the profession. People go into the profession because they believe that that there is opportunity in the industry. So yeah, I think I would say, we just have too few homes in the market right now, right? Whether you look at existing homeowners not selling their homes currently or choosing to sit out the market, or the fact that builders just haven't built enough for the needs that are out there.
Yeah. Okay. So that is an excellent segue. So let's start talking about the market. So you've been at Zillow for about a year or so.
Yeah, that's right. About 7-8 months.
Yeah. So what are you finding at Zillow? What kind of information are you? In fact, before we dive into that, let's talk about your perspective on the market for 2023. I've noticed that you're sort of fairly optimistic in a city that can be pretty pessimistic about, home prices and economy. Give me your overall view right now. It's near the end of January. So
yeah, that's right. I think we saw that kind of deep freeze in 2022. And I'm optimistic because, when you look at December, this December data that came in, existing home sales fell by less than expected. You're seeing that mortgage rates fell for 4 consecutive months, right, trending down, and buyers are out there. They're waiting and ready to pounce. In the first couple of weeks of January, what we saw was an uptick in mortgage applications, and so this notion that buyers are sitting it out and they're not going to come back. I don't subscribe to that too much. I think affordability being the main challenge in the market in 2022 means that as affordability improves, even just a little bit, we should see buyers come back to the bargaining table.
The marginal buyer and the affordability is pretty impactful.
That's right.
So do you have a view on coming recession?
Yeah, I think certainty. Yeah, it's very difficult, right? You look at all the pundits out there, right? So, last week, 2 weeks ago, everybody was screaming, "Hey, recession, recession, recession." This week, people are saying, "Hey, maybe we could avoid a recession." I think we should just bring it back down to like the basic blocks of every economy, right? And to me, the basic blocks, the way I think about it is, look, it's households, right? And so you have to think about, consumption makes up roughly 70% of GDP. And so what's going on with households, right? Inflation's still too high. We're at roughly 6.4%, still outpacing wage growth, which means basically, people are being squeezed. The Fed's is still raising interest rates. And so, of course, that's going to squeeze households. The savings rates has dipped from roughly 7% to less than 3% in 2022. And so people are using up all of their savings and are not saving as much as they used to. Credit card debt rose by roughly 15% in 2022. And so, yeah, it paints a kind of a dim picture for the household. Will households be able to kind of sustain all of the headwinds and continue to push the U.S. economy ahead? That's a big question. Then you have to look at business investment, right? So roughly 12 to 15% of GDP, falling residential investment, right? So less new construction. Housing starts we saw decline tremendously in 2022. That historically precedes a recession. And so you look at the history. You look at housing starts falling, and that's usually a predictor that a recession is coming. And yet, construction employment is still very high. So housing starts may have fallen, but there's a record number of new homes under construction, and that's keeping the industry going. We also see interest rate sensitive industries cutting back a lot. So we saw the tech sector, mortgage rate, business also cut back in terms of employment. And so that kind of gives you a picture of where businesses are at. We know that if demand weakens further, they're going to pull back. They're already somewhat pulling back on hiring. but then they're not laying off. Layoffs haven't ticked up that much yet. All right, so that gives you a picture for businesses, and then you have to worry about government, right? Another major block. Government, fiscal policy. There's always some uncertainty there, but a divided government tends to do less. So that could potentially be a good thing. Fewer potential new shocks to worry about. However, we also have the debt ceiling risk, which I wrote about, last week. Any delay in addressing this issue could actually raise borrowing costs and push the economy into contraction territory. So that kind of gives you a complete picture of how I think about these things when I hear predictions out there.
That's actually exactly what I was looking for. Your framework for how to analyze what may be coming. The thing that it triggered in my mind was about the trading delay, the delay between the economy impacts, and there's some obviously weakening factors that you were talking about in there, and the delay between that and jobs, and the delay between jobs, or the headwinds on the household, and I got to sell my house. I can't make my mortgage payment.
Right.
And so, that trading delay, and some of the factors I've seen is like, if you think about, I lose my job, I'm out of my job for 90 days. Now I'm worried about making my mortgage payment. Then I stop making my mortgage payment. Now it's 90 more days before I start getting in a distressed scenario with the bank. That's 6 months at a minimum delay before we start seeing housing inventory in there. So,
and by that time, the U.S. economy could have rebounded. You could have gained a new job, right?
Yeah. So, so then given those things, when we look at 2023 and into 2024, what's your take?
Yeah, I think there are significant headwinds, but I think I'm on camp. We can avoid this recession. This recession everybody's talking about.
Yeah.
And so what does that actually mean for the housing market? It means that the buyers waiting in the wings will still be there, and we should be ready for that upswing, right? For that rebound. Now the other issue, though, is that potentially, mortgage rates may not fall that much more than they have already, right? And so that's a bit of a concern, right? So a lot, we thought, with inflation coming down and kind of the U.S. economy slowing, right, and the risk of recession increasing, mortgage rates would continue to drop. But if we avoid that recession, right, and if the market's overpricing the risk of recession, then mortgage rates might actually just continue to stay where they're at, and they might not fall further. Now, the good news is that, a lot of research just shows that, there's still about 12 million Americans that could afford the mortgage payment, the typical mortgage payment in their local market, even at 7% mortgage rates. And so I think that, people will move. They move for different reasons, not just because of the mortgage rate. I think the mortgage rate happens to be kind of in the budget constraint, right? It's the constraint on your decisions. And so I think people will get back to normal, will get back to moving, if they can afford to do so. And so I'm fairly optimistic that even if mortgage rates hover around 6%, and stay kind of where they're at, we're going to see people come back into the market, and the market will start to head back in a positive direction. Now, of course, I think the constraint for housing is still going to be on the inventory side. And I follow your work as well, and I look at our data, and inventory is just not increasing at the pace that a lot of people thought it was going to be increasing with a market slowdown.
Yeah, it's certainly been lower than I've expected it to be.
Right.
So, okay, that's terrific, and it's an excellent segue to the next parts that I'm interested in. So, you've been with Zillow 7, 8 months. You just published the December Zillow housing market report. Any surprise findings in that one?
Yeah, and, again, I'm fairly optimistic on the team, right? So I don't think I was too surprised to see that basically, I think home buying activity picked up a little bit in December. We expected it to fall much more than it did. You saw existing home sales falling by less than expected. I think there are buyers, there are shoppers out there that wanted to take advantage of these falling mortgage rates. And I think we're going to continue to see that heading into January and even going into the spring home buying season. Of course, that depends on whether or not there are new shocks along the way. But if mortgage rates continue to hover around where they're at, 6.1% or so, I think a lot of buyers will start to head back into the market. The challenge again is, new listings are down, continue to be much lower than they were a year ago. And so there's not a ton of new existing homes coming on the market. And so I think that's going to remain a challenge. Of course, in the most expensive areas, you had a surge in inventory when compared to last year. But overall, you look at the U.S. housing market, inventory is well below where it was before the pandemic. So the path to normal is really, really slow. But buyers are ready to go, and that, I think that was, to me, that's the most surprising thing. The idea that while everybody was screaming, prices are going to fall a lot, sellers are going to come, we're not in that situation where sellers are desperate to sell. I lean on an interesting fact that I saw on Realtors that Realtors shared midway through 2022. Today, 1% of Realtors are working with a distressed seller compared to 49% before the global financial crisis, right? So sellers are not desperate to sell. And so, we need, if we're going to get that inventory, that uptick in housing market activity, we're going to need those homes that are under construction to come back on the market,
Yeah. There's so many threads in there that I want to pull on, but the one question that pops up. So, are you finding insight in the massive Zillow sphere that you weren't able to get in previous work or academia? Like, are there some fun things in there that you're finding?
Oh, absolutely. Zillow having access to every house on or off the market, the characteristics, features, our Zestimate, the potential features that home buyers are actually looking for, right? I think that's phenomenal. Having access to that information at a very granular level, down to the zip code, at Zillow, we use this term, turn on the lights. Our goal is to turn on the lights. It's to turn on the lights for home buyers, for sellers, for realtors. It's to make the home buying and selling process as painless as possible. And of course, that means supporting realtors. It means helping buyers understand mortgage financing, and just kind of putting all these pieces together. And so I find that very, very exciting. Some of our social impact work as well, helping at-risk renters and helping people that are kind of, on the fringe that may not be able to access home ownership and helping them get prepared. So I think that is fascinating work. And of course, coming from a poorer country and having seen kind of people struggle, I think working for a company that's focused on, helping people access home ownership is exciting to me.
I bet it is. That does sound really terrific. Were there specifics, any specifics and things like features that, now you've only been looking at that data for less than a year, but are there trends in features that we can see, like home features that you can see in any of that? Anything interesting?
Yeah, I mean, like the in some places, the need for air conditioning, for example, is quite interesting. But yeah, in this current environment, I think what is jumping out is the fact that people are settling for less, like in terms of sizes, right? Number of bedrooms and square footage. People are settling for less. At least during the pandemic, when prices rose so much, the cost of space really increased, and so you saw people settle for less, even at the higher end, with the $1 million listings, where people were actually just shrinking their footprint, really. And so I thought that was really interesting. Another thing that I find interesting is the fact that people are moving to Florida, and that house prices have been sliding since midway this year, and Florida markets are super hot, are still so hot. I mean, they're cooling, but they're still too hot. I mean, 19% year over year price growth in places like Tampa and Jacksonville, right? I find that really, really interesting, given, of course, the fact that, Florida is you have all these hurricanes and flooding, and, the idea that potential home buyers, are still going into these areas, and that those markets are super attractive to a lot of people is kind of surprising to me.
That's interesting. So yeah, the folks, the natural disaster risk seems underpriced to me in Florida, and certainly like insurance wise, like it seems like that there's still some shakeout to happen in a climate changing world. But the hot Florida market is kind of, let's talk about that for a second. So we can see it in the Altos data, the Western hot markets, the Phoenix, Austin, Boise, Salt Lake, Denver, those guys all backed way off this year. And notably, the Florida markets backed less off.
That's right.
Is that part of your the Zillow hottest markets predictions for 2023? I think you guys just had something come out there.
No, as our hottest markets are mostly in the Midwest. We really believe that affordability will really be the driving factor going into 2023.
Yep.
And that people are going to go to places that are relatively more affordable.
Yep.
And so I think that's probably where we're thinking. But I think that at least it's not something I've tested yet. But I think that potentially the Florida phenomenon is due to a lack of inventory. You have all these people that are moving there, that moved there in 2022. I think Florida was driving most of the domestic migration, was at the top of the list. And then you have this climate risk, which actually destroys housing inventory. And so you end up with a situation where, these supply shocks could actually push prices up. If you go back to this interesting research that was done on what happened after Hurricane Katrina, and something similar happened. People expected housing values to decline post Hurricane Katrina, and instead, the market there actually gained. Home prices actually increased post Hurricane Katrina much faster than the rest of the country, and so supply shocks, right? So we know house prices, determinants of house prices are on the demand side. Right? You have income, population, employment, mortgage rates. But on the supply side, you also have geographical constraints, right? That are kind of natural constraints. And then you have, man-made constraints, of course, with policies, right? Zoning laws, etc. And so these natural constraints, and of course, you have this climate change element. And so I think that markets that are going to be subjected to massive shocks are probably going to see upward pressure on prices, at least in the near term.
That's an interesting take. Like climate risk could potentially drive prices higher, home prices higher.
That's right.
Wow, that's okay. And I can see that, in California, the fire markets, the Napas and thing, like destroying a lot of homes, or Boulder, the fire a winter ago in the middle of December took out 1,000 homes in Boulder, Colorado. And like, that's a significant change and doesn't really impact the number of people who want to live there.
That's right. And until people start to kind of take this into account, right, and start to price that risk,
Yeah.
uh, then home values there's going to be upward pressure on home values in those markets.
And of course, humans can't really price properly risk things like climate risk, amorphous, long-term, long tail kind of risks. We can't we can't put a dollar on it at all. That's really fascinating. Yeah, the I got to make some notes here. I love that thought. So let's go back to affordability and the hot markets take. So one thing I've noticed in the Altos data this winter is that we obviously have seen we saw inventory climb in the Western markets, the Austins and Phoenix, back to 2019 pre-pandemic levels. But much of the Midwest and Northeast is still at sort of crisis lows. And so we have low inventory there, but we also didn't have the big run up in prices during the pandemic.
Right.
So how should we think about affordability and the Midwestern markets?
Yeah, so you're going to have people who want to own a home and who may not have to stay in the most expensive cities to work, right? We saw work from home is here to stay. I think most of the data indicates that, people are still moving and staying away from the office. And so, if you combine those factors, you probably have people moving to relatively more affordable markets. And so, if you have very low inventory in some of those markets, that will actually sustain house prices, if you take the country, across the country. And so you're going to have some markets that are seeing, prices decline a lot, home values fall, like Boise and some of these very expensive, Austin, right? Very expensive markets. But then you're going to have upward pressure on prices in places that are still relatively affordable. And that's why, you take that all together. And at Zillow, we really don't think, we think home values might actually kind of stay flat. Our forecast is like, okay, maybe we'll stay flat or we'll see a small decline, not the kind of decline, nationwide that we saw during the Great Recession, for example.
Right, for sure. And so does Zillow have a view on home prices, or does Zillow have a view on like a forecast for the year for home prices across the country?
Yeah, that's it. We think we're going to be relatively flat or start to see a small decline. I can't think of the number off the top of my head, but the decline. I personally thought that even when the argument started, the discussion started about whether prices were going to fall by 20%, 25%. My thought exercise was what part of the prices today are supported by fundamentals, right? And how much of how high are prices relative to what we think fundamentals support, right? And so my personal take is, I think, prices might have gone up by 5 to 10%, maybe, right? And so over what fundamentals would support. And so, it's hard for me to reconcile predictions of, a 20%, 25% price decline. And I mentioned this to you in our social media conversations.
Yeah. Well, that's, and I appreciate that. And it's 25% is across the board is pretty significant. You have to have a pretty bearish view on a bunch of factors to get there. But you did actually introduce one thing that I want to ask about. So you mentioned the debt ceiling as a shock that could get thrown into this system actually pretty soon, next few months. So you wrote about this recently. Tell me about, should I be worried about the debt ceiling?
So yeah, I don't think the U.S. will ever default, really, no. At least not this year anyway. But just the tension, the delay in addressing this issue. We saw that back in 2011 with President Obama back then, and in a Republican Congress, and this delay actually had an effect on borrowing costs across the U.S. and we start to see the economy kind of slow down as a result. And so I think this is one of those man-made things we could be avoiding, right? We could actually address this issue right away, make sure there's no uncertainty. There's already enough uncertainty right now for investors. Adding on to investors' fears right now is not a good idea. Because higher borrowing costs could actually push the U.S. economy into contraction territory. I think there's an interesting study that was done by Moody's maybe last year that showed that basically, something like that could actually push the unemployment rate up, and really, if people have been talking about a recession, I think this is the thing that could actually push us into recession territory.
That's fascinating. All right, I'm going to start paying more attention to it. It was, vaguely in my mind with a bunch of, political stuff that I try to keep the volume down low enough.
Same here, man.
To keep my stress levels down, right? But it's something that it is a factor that we should pay attention to, because, one of the things in my work is that we're trying to measure what's going on right now, and people tend to, especially on Twitter, they like to read that and say, but there's all these other things in the future that could happen, and therefore I have this opinion on the world. And my view is like, yes, when that happens, we'll measure that and we'll report on that too. But I'm often taken by surprise by events that I didn't plan for. I didn't expected mortgage rates to go up in 2022, but 7.5, I did not expect.
That's right.
So, do you have, and this may be beyond the scope of what you wrote about, but do you have any magnitude on borrowing costs that you would expect? Like if it starts to get really down to the wire?
Yeah, no, I don't have a magnitude. I didn't, I just looked at what happened in 2011 and really, like, we saw what happened to the housing market when mortgage rates shot up above 7%, right? And so we should really be, worried about that, as a potential threat to the housing market in 2023. And so, yeah, that's kind of why I started thinking about it a little bit more, because the market seems to be headed, it's headed into that spring season, and things seem to be moving, at least from a buyer's perspective. Of course, we still need those units to come on the market in most U.S. markets, but that could throw an extra another issue to deal with, right? For buyers, and pull them back, and so that's something, not only that, but also, right? So higher borrowing costs mean cost of businesses. So far, we're seeing layoffs remaining fairly low, but higher costs for businesses could mean, right, we're already seeing less hiring, but then also potential layoffs, and then we see the unemployment rate shoot up, which could really change the picture in the housing market, right? Because so right now we have homeowners on very good financial footing with good credit, better credit than we had the last time that we saw housing market softness, and the labor market's holding. If you throw a wrench into that mix, and all of a sudden you start to see, job losses and higher mortgage rates, then there's no telling what would happen in terms of, homeowners actually having to list their homes because of an income shock, which, it is completely avoidable right now.
Yeah. Wow. That's really fascinating. Are there other things in the media, the headlines or the zeitgeist, that you think are wrong now?
Yeah, absolutely. I by the way, I pay a lot of attention. I probably shouldn't, but I do anyway. I pay a lot of attention to some of these podcasts out there, the pundits on YouTube, and it's crazy what you see out there, right? So you have people who are, there's this guy, I won't name his name, but he goes around these construction sites and he says, "Hey, look, no one's living here. people are running out. They're not, they're getting rid of their homes. They can't, right? And it's a little bit like what you saw before the global financial crisis, where there was a serious problem, right? People were leaving their homes because they couldn't afford the mortgage payments anymore. Today, we know that's not true. There are a few distressed sellers out there. There's a high share of low fixed rate outstanding mortgages. Homeowners are on better financial footing and with better credit. The labor market's holding up well. 2 weeks ago, we were talking about a recession. Now we're talking about avoiding a recession because of how resilient households and U.S. consumers are. And so, the idea that today's price correction it could be caused by people, not being able to afford their mortgage payments is just completely, crazy. The reality is, affordability challenges, because a lot of people are buying homes, are the reason why buyers have now pulled back, right? A lot of people are buying homes. Prices rose a lot. More prices of everything increased, which is why we reached, inflation that had not been seen in 40 years. And so the Fed had to bring this back a little bit by raising interest rates. So affordability is the challenge. It's not, the price correction that we're seeing in some markets is not due to people abandoning their homes because they can't afford the mortgage payments. So I think this is the thing that I see a lot out there that I try to correct the narrative on, right? What's causing the pullback is the affordability challenges. It's not homeowners not being able to afford their mortgage payments. The data is very clear. New listings are down. Existing homeowners are not listing their homes. They're pulling back. They're pulling back because they're locked into these low, 2.75%, my neighbor's mortgage rate, right? Low mortgage payment. He's not going to trade it for the 6.1% mortgage rate today,
Yeah. Well, and of course, correcting the narrative, that's a quite a quixotic task to do, correcting those, because man, those YouTube channels get orders of magnitude more attention than those of us who are just like, we're just trying to look at the actual data.
That's right.
So that's quite a task, but so they do. Some of those guys are nuts, but some of those guys there's some real fears in there. There's some real fears. The Fed was buying, the mortgage-backed securities and keeping mortgage rates low for a long time. That is a last decade phenomenon. It didn't happen before that, and now it's going away now. Do some of those things, some of the underlying grand fears of a big regime shift in the Fed, for example, do those have any merit? Like, should we be worried about it for not just maybe 2023, but like the next decade?
Yeah, I think people need to keep in mind the fact that the Fed has a dual mandate, and that the Fed will never let the U.S. economy crash because of its dual mandate, right? So, the dual mandate is, right, price stability, but also, keeping the unemployment rate in check. And so, it's a very difficult task, but, the Fed will not do things in a way that causes, a crash or dysfunction in financial markets.
So you have sort of confidence that the unwinding happens, that it'll not be disruptive unwinding, quantitative tightening.
Absolutely.
Okay.
Absolutely.
Well, that's good. I like to hear some reassurance in there, because there's like a part of me that fears, like, all of our assumptions about home prices and affordability and mortgage rates have been built on a set of assumptions that are no longer true.
Yeah, and investors are showing you exactly what happens when the market expects a recession, right? So, a recession actually means mortgage rates could fall even more. So I'm not I'm not afraid of a small correction, because I know that a small correction could result in affordability improving even more. And and people, and of course we know that because there's still a lot of job openings out there, that and layoffs are lower than they were even before the pandemic, that they'll still be, it might actually housing market activity. Going back to some of what we started with in terms of trading delays, the idea that there were lots of people in the market, and that demographic factors might be playing a role into why we saw the surge in demand during the pandemic. And of course that a lot of people wanted to buy a home and just couldn't do that anymore, means that there's a lot of people that will be ready or wanting to take advantage of falling mortgage rates to come back in the market, because they need more space, because they're working from home, because they started a family, and they were bid out by in the market during the pandemic.
Yeah. Yes, for sure. That kind of transitions us into the one thing I'd like to ask all my guests is the longer term future, longer term future for housing, thinking about demographics and our construction and all of the factors. What do you see and for the next few years, decade? Are there big ideas that we should be paying attention to? Big trends?
Yeah, going into the future, I worry about builders pulling back so much, right? Housing starts fell a lot in 2022, and so builders are pulling back in an environment where I think we still need housing, especially we have some cities where the housing unit deficit is vast, and so I think that could be a challenge for the housing market. Going forward, we look at inventory right now, and we both, we look at the data, and it's like inventory is so low. Even if you bring on all these new constructions that are being built right now, these new homes that are being built right now, that might not be enough. And so I think we still somewhat underbuilt. And then I also worry about the types of units that we're building, like at what price point. Right, a lot of families in the United States that are doubling up. They're living with other families, either in rented housing or in owner-occupied housing. A lot of these families have, on average, lower income than the median family in the United States. And so these people will need affordable housing, not just any house, right? Any old house, they'll need affordable housing. And so improving productivity in the construction sector, maybe deregulating somewhat in order to bring builder costs lower, is going to help us put more affordable units on the market for those families.
Yeah, it has become significantly more difficult over the last decade to build entry-level housing profitably.
Right.
We're in a world right now where we've had big inflation on building costs. We've had labor cost inflation. We've had restricted immigration. So our labor pool for home construction is low. Is there any sign? Are there any, I don't know if you've paid attention, have you seen any signs of regulation changing to help us maybe build better, some of those things?
Look, I'm optimistic on not so much on the regulatory side, although so many of us are working on this, even at Zillow as well, our government relations team, just to try to talk to lawmakers about the problems, the challenges that we're facing on the regulatory front. But I'm excited about the technology, prefab modular homes, prefab homes, 3D home printing, container homes, barn dominiums. I'm really excited about the shifts that we're seeing and where this could go. Right, the technology might actually get us there faster than the regulators.
Oh, well, isn't that sort of excellent, tech company, Silicon Valley, Seattle attitude, the techno optimists, right? Technology gets to save our world. And it's actually an interesting thing to tie it all the way back to our initial part of the conversation in the trading delay, the technology shrinking the trading delay in housing. The technology is solving some of the affordability problems, but also maybe some of the trading delay problems. Have you seen things in there that catch your attention?
Yeah, and look, I think it's a wonderful thing, right? Like, you ask people where they find their jobs. They find their jobs on LinkedIn, right? Do you remember the days when you actually had to like take your CV and walk door to door and ask people like, hey, I'm available, all right, you had to go through the yellow pages and and kind of go from business to business to look for a job. It's a beautiful thing that we have hundreds of millions of visitors that go on the website and they look at housing, whether it's a for sale inventory or rental inventory, and they're able to see quickly, hey, here's what I can afford. We have an affordability calculator. Here's what I can afford. We can put you in touch with a realtor, right? An agent to help you out, to sort through your options, right? Being able to do this so quickly. Of course, the mortgage space is very complex. For anybody who's ever bought a house, even for me, it's really, really hard. Now we have the 2-to-1 rate buy down. Like, what does that mean? What does that do to my closing costs? Who's paying this stuff? I looked at recently at the National Survey of Mortgage Originations, and you look at the percentage of people who actually know about how much money they'll need as a down payment or even closing costs. Most people are unsure about what their mortgage payment, down payment should be, or what their closing costs are going to be. And so, they come to the table completely unsure, unprepared for that journey, right? It's a complex journey. And I'm excited to see that Zillow is really focused on trying to smooth out this process and remove the complexity from the home buying process.
I love it. That's an excellent place to put a bow on it for our conversation. Orphe, has really been a terrific discussion. I really appreciate your depth with the numbers and your take on the year and the broader economy. Like, it's really, really informative for me. So I appreciate it very much.
Oh, thanks for having me. Anytime, Mike.
And so where do people find you? Twitter, LinkedIn, how should they
Twitter,
find
LinkedIn, you? But yeah, check out our website, Zillow Research, right? You Google Zillow Research, you can find all of our work, our commentary. And of course, I always encourage people to follow me on LinkedIn. Go and ask me any question, right? And we can chat through it, to look at the data and kind of make sense of it.
That's great. And I can find your debt ceiling article on Zillow Research.
That's right. So every week we put out a commentary on mortgage rates, and where mortgage rates are and where we think they're headed and what's driving mortgage rates. And so so I wrote a piece, I think last week, on what was happening in the market at that time and what we expect will be coming up with this debt ceiling issue.
Terrific. I'll go read that for sure. Definitely follow Orphe on Twitter and LinkedIn and it's a great conversation. One of my favorites to interact with. So appreciate that. Everybody, this is the Top of Mind podcast. You can like it and give us a thumbs up on the ratings, because if you're enjoying it, but if you're enjoying it as much as I do, but I'm really having a good time. So that's it for today, everybody. Thanks so much, and we'll be back next week.
Thanks for listening to Top of Mind. See you again next time, and be sure to click subscribe to get future episodes.